This video series is educational in nature rather than advisory. It is always important to consult with your financial advisor before investing. Position Sizing Technologies. Position sizing is a trademark of Position Sizing Technologies. Dr. Van Tharp's Secrets to Profits, the Position Sizing Workshop. This workshop is about position sizing, and it covers strategies that control how much you should invest in any investment or trade throughout its duration. It's the key to meeting your objectives in the market. Tape 2, Real-Life Applications. And now, Dr. Van Tharp.
What I want to do today is to give you some practical applications of how all of the position sizing material you've been learning will apply to real-world trading in the stock market. So what I'm going to do is show you with some examples from a club recommendation, the Oxford Club. I'm a director of, or a advisory panel member for the Oxford Club. So I gave elements of this talk for them, and in that talk we basically reviewed the trade recommendations that they'd had from the beginning of 1999 until April, right after we had the big decline in the stock market. Steve Sugarwood was the director of research, made all these recommendations in the newsletter, and what he'd done is he'd basically told the members to have a 25% trailing stop, which means at the buy price where he let them in or recommended the stock, if it went down 25% from there, they were out. In addition, as the price went up, every time it made a new high, a new stop would be calculated 25% away from that new high. So it was a 25% trailing stop. So if the market went from 100, say, to 200, at 100 the stop would be 75, 25% away. At 200, the stop would be 150. So once it got to 200, when it got down to 150, they'd be out. So when I first looked at this, I didn't know if that kind of stop was any good. I'd never seen it before. I knew it was pretty much just designed to make it easy for the members. So I wanted to see how it did. And also they showed recommendations for their own trades to say, well, this trade was up 63% and this trade was up 800%. And I don't think that way. I think in terms of R multiples. So I wanted to look at all of that to see how it was done. So what I'm going to show you is that kind of data and give you some real-world applications for how to apply this to the markets and to your own trading. Your trading might be just like this. I mean, for example, if you just bought stocks that were going up and had a 25% trailing stop, in the market this was in, you'd probably do better than this. Because a lot of the ones that were stopped out were not necessarily ones that were going up at the time. So I'm going to show you that. I'll show you how to calculate the expectancy of those trades. And I'll also show you how to look at the R multiples and how to simulate this. First of all, let's talk a little bit about R multiples. R is your risk. It's the risk you have in here. In this case, it's a 25% trailing stop. So whatever the price is, it's 25% from that entry price or from any highs that are subsequently made. So if you risk $700 and it goes, and that risk is what I call R. So now let's look at a portfolio, for example. It says, let's say you have 100,000 to begin with. For that 100,000, if you're going to risk 1%, you'd risk $1,000. Since the stop is 25% of the value of the stock, you would basically invest $4,000 in any given stock, 4%, and the risk would be the $1,000, at least initially when you started. Does that make sense? And what happens is that initial amount that you risk, which is $1,000 or whatever it is what I call R. And the amount that you make, or in profit or loss, is some multiple of that R. It might be half an R. If it goes down, or if it goes down but you get stopped out at a $500 loss, it will be a half R loss. If it goes up to $4,000, then you would have a 4R gain. And in some of these examples here, $700 loss, your profit is $2,800, that's 4R. If it's a $1,000 loss, it's up $10,000, you have a 10R. $500 risk, $250 loss, it's a half R. $500 loss, and you lose 1,000, which can happen if it gaps against you, things like that. It's a 2R loss. And generally, you want your R multiples to be very large, and your losses to be 1R or less. You might get 2 Rs, and anything over 2 Rs in the neighborhood of 2 to 5 or more tends to be a psychological error as far as I'm concerned. So when you're computing R multiples, the first thing you do, as I said, is compute your initial risk. Again, in this case, it's 25%. So 1R is 25% of the value of the stock. And then you need to determine your profit. At the end, you need to determine what your profit or loss is. And the nice thing about this is you can include commissions. And you typically won't get even numbers. It'll be like 2.17 or something like that, which is what happens when you divide that profit or loss by the initial R. So let's look at a couple of examples. Okay, in this example, you initially, one of their first trades was ALA, and it was taken in January 1999 at $23. So 25% of that $23 is $5.75. Now your risk is $1,000, but what you have to do to determine your number of shares is to divide R into the risk. When you divide 575 into 1,000, you get 174 shares. Now, in the game you played, it was real easy because we made the assumption that R was 1. So you divide R, you divide your risk of 1%, say $1,000 by 1, you're going to get $1,000. You didn't have to do any calculations. But to figure out how much, you've got to divide the initial, your risk, whatever percentage of your portfolio you're risking, by R. In this particular case, they exited this stock when it reached $38.50. In other words, it was trailed up. When it got to a certain level, it dropped back down. They exited at $38.50. The profit was $2,635.65, and if you divide that by $1,000, you get 2.64. So that is the R multiple for that trade. And the next example's very similar. You buy the stock at $4.63. 25% of that is $1.16. If you divide $1.16 into 1,000, you're going to get 864 shares. So that's what you buy of this one. That's the way you keep a constant risk all the time. You have a constant $1,000 risk. You have to buy, with that 25% trailing stop, you have to figure out how many shares to buy by dividing what your bit by your stop. And this one, the exit price was 401. In other words, they took a loss on it. The loss was $595.64. So generally, if you divide that up by 1,000, you get a minus 0.6 R. So that's how that works. So this is an example of all of the trades recommended from January 99 through April. And in this case, I've calculated all of the R multiples. In each case, we took the recommended price, 25% of that was where the stop was. Figure out how much that is. Divide $1,000 is the initial risk, which is 1%. Divide that the stop, which is R, into that. You get the number of shares. Then you get the exit price. Figure out what the profit or loss would have been. And the result is your series of R multiples at the far right of the chart. And you notice they range from plus 31.89. In this case, I put $30 commission on either side of the trade just to add it in. The total, if you sum all of those up, you get a total R value. The negatives are subtracted, of course. You get a total R value of 51.02. And then you divide that by the number of trades, you get an expectancy there of 2.43. And that's the expectancy of that sample. So you can compare 2.143 with the expectancy of the marble game you played and get some idea of just how they compare. This was a very good system. But if you subtract that one trade at 31, you basically now have an expectancy of 1. Just eliminating that one trade takes the expectancy down to 1. Eliminating 2 or 3 takes it down to about a half R, eliminating the top 2 or 3. But expectancy is an overall objective way of rating how good your trading system is. And when you do it this way, you never know exactly how your system is going to interact with the market. In this case, you have 20 samples. That's probably not enough to know your overall system. You need maybe 100. But it's at least a good start to it. And you know this is a pretty good system and you can trade it. Once again, these are all the individual stocks that were recommended and the R multiples for each. And you can see there's a 31, there's almost a 32, there's a 9, and there's a 4. Those are the best ones. Now, incidentally, those were all adjusted for splits. Basically, if a stock split in the JDSU, which was a 31 R multiple, split about 4 times during this process. So we adjusted the price all along so that it's adjusted for those splits. So you originally bought, it was probably about $40 when you originally bought it, but split adjusted, it shows up at $11. But it all works out to the same numbers. Now what I want to do here is show you how position sizing works. We're going to do 3 different models for position sizing. We're going to start out with a 1% risk, and then we're going to go to a 2% risk, and then I'm going to show you something interesting, which is a more advanced concept of a 1% risk with scaling in. If you look on this, it shows you the prices. If you look, beginning in January, you bought 3 different stocks. We're starting out with $100,000. You bought 3 different stocks, each with a $1,000 risk. Not too much happened. Then March comes along. There's 2 more recommendations. And those are simply added on. And at the end of these were all actually taken in the middle of the month, on the 15th of the month. On the 15th of the month, after the first month, you have a portfolio that's worth, it's gained $351 in value. You notice 1% is now not $1,000, it's $1,003. I pretty much ignored that just to begin with. The next month, we did one more stock. We added it in. Again, another $4,000 risk. So at the end, in mid-April 1999, we now have about $25,000 committed to stocks, and we still have $76,000 in cash. The portfolio has gone up by about $1,800. Okay? And I still, just for ease of calculation, I probably should have used the 18. For ease of calculation, I still assumed it was a $1,000 risk because it wasn't much more. It might add an extra share at this point. So in May, we have, well, we actually have a stock that is purchased and then sold. The red on that particular thing indicates that it was sold at a loss. And we've purchased 3 more. So we have our first closed out trade at a loss. And you now have approximately $45,000 worth of stocks and your $60,000 in cash still. And you're up by about 5.6%. And here's where it's going to start making a difference in how big our positions are. At this point, we're adding one more stock. We're stopped out of ABX. Again, at a loss. We now have 2 losses. You have 2 losses in a row. If you were just looking at losses and not the whole portfolio, you'd begin to wonder, but look, your portfolio is up 4% still. So that was the one new addition in June. July, we have another stopped out for a loss. We've now had 3 losses. There's no new positions. We've now got 46,000 in stocks, including the stopped out position, and you've got 64,000 in cash. Okay? So we go to August. We're stopped out of another one. This time, we have our first profit. In fact, this one's a huge profit. Stopped out at 82, and you originally got in at 24. One new position, again, is added. At this point, you're up. You still have 63,000 in cash, and you're up about 16%. So now we go to September. There's no new September purchases. Nothing interesting happens in September. And we now also go to October. In October, we have 2 new purchases, and we have 2 more stocks that are stopped out of a loss. So now we've had 5 losses and 1 gain. You now begin to think, this is a horrible trading system. 5 losses and 1 gain. You're only right 1 time. But look at the portfolio. It's up 17%. And you still haven't even committed 50% of your portfolio to the market. November, we have 1 more stock stopped out of a loss. You now got 6 out of 7 losers. But you're up 29%. December 1999, you had 3 more purchases. And now we're about 34% up. And we still have 62,000 in cash. So we get into this year, the year 2000. In January, we've got 2 more losses. This time, the first one's at a nice gain, and the second one is also at a slight gain. They're not that significant. At this point, we're now up 51%. 51% we've gone through a year. But I'm going to take you through the big crash. when the Dow was, or from the NASDAQ. Most of these are NASDAQ stocks, so this is when the NASDAQ was down 30% in 1 month, so you can see what happens. February, we add 1 new stock, and we're stopped out of 2 more. Again, 1 at a loss, 1 at a nice profit. You're up 53% at this point. Now we go into March. Right around March 15th, which is when this happened, this is the peak of the market. At this point, you're stopped out of the stock you bought last time, but at a nice profit, and you're adding 2 more. So right at the peak of the market, you're adding 2 more stocks. And now the next month basically goes through the crash from April 15th or March 15th to April 15th. You can see you suddenly get stopped out of 5 stocks, and you end up being up 55% during that period. Your drawdown is from 63,000 to 55,000. But if you look at this point now, April 15th, which is where it really got bad, you now have $25,000 worth of stock, and you're now $130,000 cash. So you can't even have a very bad drawdown unless these things go to 0. Even that isn't a tremendous drawdown. It's nowhere near what would happen if you were doing position sizing of the way some people have, where all our money's in 1 or 2 stocks. So what I want to do is show you month by month now what happens with this, so you can see how it works and how it happens. First, there's only 3 losing months. This is for the whole portfolio. You lose in June slightly, about 1%. You lose about 0.3% in September. And you're down 5.2% in that month when the NASDAQ's down 30%. And overall, you have a monthly gain of, you're up 55%, and you have an average monthly gain of 3.3% during this period of time. So now let's look at another model, because we never went much more than 50%. We were never much more than 50% invested during this whole time period with this particular model. We're still up 55%. 2% risk, I'm not going to show you all the details month to month, but I'll show you exactly what happens. Basically, at 2% risk, you're investing $8,000 worth of stock with $2,000 risk. Otherwise, it's all the same. And basically, everything doubles. At the end, you're up 111%. You never went more, I think the cash, June 1999 was the lowest you were in cash, which was 17,000. So you're 83% invested there. By April 15th, you were 149,000 in cash and 62,000 in stock. You still had some potential for drawdown. But you only had an 8% drawdown, even with this, in that worst month, when the market, when the NASDAQ as a whole was down 30%. Now, golden rule of trading is to cut your losses short, let your profits run. So we're going to show, now I'm going to show you what happens. Let's go to something, let's do that with position sizing. The way you do it with position sizing is when you raise your stop 25%, you add another position. You've locked your risk out, you add another position. We're going to allow you to scale, I call this scaling in, and I'm going to allow you to do it up to 4 times. With JDSU, the big one, you could have done it more times than that. And I only had data on the 15th, so I made a few rules just to be conservative, which is if you were stopped out of a stock the same month you entered, even if it was at a huge profit, and there were several examples of that, I didn't scale in, even though you could have. So that makes these results a bit conservative.
So let's summarize. Our goal is to add to our winners through position sizing. Whenever a stock goes up 25% from the price you last bought it at, we'll add an additional 1% risk position to it. We will do this up to 4 times. For example, we buy JDSU at $11.95. When the price passes $14.95, goes up 25%, we'll add another 1% risk position. Now let's go back and see how it was applied.
So here's this first month. If you look at February, not much change. March, not much change. And April's the first interesting month because JDSU, this is our big one, has now risen enough to do the first scale in. So this is like an added position now that you wouldn't have had otherwise. You now have 2 units of JDSU. So then we go to May. We get stopped out of at home, and at the bottom we get a scale in on Nextel. So you have another scale in that's created because the stock's gone up enough to for you to raise your stops to break even. Nothing new here in June. In July, there's no new positions, but you have 3 scale-ins. You have your second scale-in on JDSU, your second scale-in on Nextel, and your first scale-in on Adobe. So you got 2% risk on Adobe, and you've really got 3% risk on JDSU and Nextel. And why not? Those are the big R multiples anyway. And we didn't know they were going to be that way ahead of time. Go to August. Now, the Nextel is stopped out. This is one we've done 2 of. It's stopped out, and it stopped out at a price that could have caused us to scale in again, and I didn't. So there's one example where I was a bit conservative. And we add a scale in on 1 new position and the 3rd scale in on JDSU. There's nothing new in September. On October, you get the 4th scale in for JDSU. Now this one you could have scaled in a number of other times as well, but I limited it to 4, which is a total of 5% risk on this particular position. You have your second scale in on Adobe. And notice by October, you're up about 50%. November, you get the 3rd scale in on Adobe. And in December, we have 4 scale ins. The last scale in on Adobe, and the first scale in on 2 stocks, and the second scale in on another one. So it's creating new positions just by the ones that are going up. So then we get to January. We got stopped out of another stock that we could have scaled into, and I didn't count that. That's a Singapore stock, by the way. DCFT Singapore. And the other one that's strange is the Hong Kong stock that gets stopped out there. February, there's nothing new. In March, PE Biosystems is stopped out. Again, it goes up by enough that you could have scaled in, but I didn't. And remember, this is March 15th. This is about the peak of the market. So you're scaling in now by a whole bunch because everything's way up. So you're scaling into, for the second time in 2 stocks and the first time for 3 more. And here's your lowest cash position. You've got $391 in cash now. We haven't used any margin in this yet. You have $391 in cash, but you also actually have the cash from the sale, the $13,000 from that sale. I hadn't added that in yet. Notice at this point you're up 180%. You haven't used any margin, you're up 180%. So then here's the results of basically the though at least the first part of the crash, which knocks you out of a whole bunch of them, including a bunch of the scaled-in positions. Notice you have 1,200 shares of JDSU that you now get stopped out of. And you end up 160%. Your cash position is $194,000 going into the worst part of the crash, the end of April and May. And if you now look at this thing on a month-by-month basis, there's two things to notice. First, one of those losing months gets eliminated. So you don't even have a drawdown in one of the months that you had a drawdown before, I think September, because the stocks, the scale-in positions were adding enough profit that the losses didn't add enough, didn't get a loss. If you remember, you had in April, you had an 8% drawdown. You have a 7% in this one. And you're up a 160% versus 111 with the 2% risk. See the bottom line? You're up, your final bottom number is basically $260,000. So that's 160% up in this period of time, which is 15 months. And you're basically mostly cash. You're $195,000 in cash and $64,000 in equities at this point, heading into the worst part of the market. By the end of April, or by the end of May, they were out of everything. So basically, my goal in this was just to show you how to apply this. And the whole idea is, if you keep track of your R multiples, you can get some idea on your own system by doing what I showed you, which is figuring out what your initial risk is, what percentage of your equity you're going to risk, divide that R value into that initial risk into the percent risk to determine the number of shares, and then divide that overall initial risk into the profit or loss, you get your R multiple. You can determine the expectancy of your sample by adding up all the R multiples and dividing by the number of trades. That's your ongoing expectancy. You can do that in a spreadsheet and have it on an ongoing basis. When you've got about 100 trades, you've got a pretty good idea how good your system is. It's probably not going to deviate a whole lot from there. And you can begin to apply all of these things. And when you get a good system like this one that has an expectancy of 2, that means, if you think about it, you're going to make on the average 2 times what you risk on every trade. Contrast that with the game. And if we'd had a good run on the game, you'd have thought it was sensational. But it was a quarter of basically what this one was. So in this particular case, these are recommendations out of a newsletter, but you could do just as well picking stocks that are going up, using William O'Neill's system and picking stocks that are breaking out of a baseline, anything of that. In fact, also remember in this example, I think we had 6 out of 7 losers to begin with. You know, most people say this system's no good with 6 out of 7 losers. But your overall portfolio was up 20, 30% by the time you'd had 6 out of 7 losers, because you hadn't sold your big gainers. Just the closing trades, you had 6 out of 7 losers. And the net result was you were up about as much as you committed cash. If you risked 1%, you committed 50% cash, you were up about 50%. If you're up 2%, or you risked 2%, in this case you were up about 110%, and you committed just about all of your cash, 87%. And in the scale-in, you virtually committed all of it, but no margin still, and we're up 160%. And with a good filter, like if you didn't buy the if you'd looked at the charts on those stocks that were recommended, it's more of a fundamental analysis. Like these were high technology issues that had the potential to be some sort of breakthrough technology. That was a reason, a rationale behind most of them. They were more of a fundamental reason. If you just simply had a filter, does the stock pattern look good, you'd have eliminated about half the losers in this. So that's the power of applied position sizing and what you can do with it. And it makes all the difference in the world. And as you can see from the games, there's a big difference between what everybody does just as a factor of position sizing. Everybody gets a different results according to your objectives and what you do for position sizing. The only difference between those marble games and the real-world application is that R is generally more than 1 in the real world. So to determine your actual number of units, you have to divide by what your R value is in dollars to determine how many shares. Otherwise, it's the same as the game, and that's the value of playing those simulation games. Now, how would you simulate a system like this? That initial slide, which showed you your R multiples, you could round them off and put them into a marble bag and play this exact system. First, if you look at these, most of them, they're only a couple. There's only one that's over 1, where you took a slightly bigger loss than your initial position. And remember, I'm adding commissions in here. So you'd expect if you got stopped out immediately, it would be more than 1. And most of them are small fractions of 1. And you could round these off, put them in little bins or something, and use a marble for each one of those. And better yet, if you have our trading game, all those numbers, those exact numbers could be plugged into the trading game and used to simulate this set of systems. And we accept something like 50 to 100 marbles, different marbles in there.
You should review this tape until you understand these key points. They are critical to comprehending the material that follows. This is the end of Tape 2. Please continue with Tape 3 of the Position Sizing Workshop, where you will learn about optimal position sizing and how to meet your objectives.